Hey there, happy Tuesday, September 11th. Quick moment to just remember 9/11 and all of the families and lives that were lost on that day. It's still deep in our hearts as Americans, and hope that we can all take a minute just to remember. But with that being said, I wanted to bring you this week's market update. There's a lot of stuff going on there. Rates continue to trend pretty favorably. FHA loans still in the mid 3.5% range and conforming up in the upper threes, depending on your FICO score. So still very healthy, but there's a lot of stuff moving out there, so we got to pay attention. So I'm going to bring up the charts so we can kind of walk through this. This is the interactive chart. You can kind of see where we've been trading. Go back to the end of July. Probably the highest point for mortgage-backed securities we saw there, which resulted in the lowest rates that we have seen. And then we had some big sell-off middle of August. Since then, we've rebounded pretty nicely, and we're kind of trading in a narrow range again here. A little bit off today, but a lot of that is driven by the kind of economic news. So there's a lot going on this week. I thought it'd be good to kind of look at the economic calendar and kind of show you a little bit about what drives the market. So we're going to pull this up. These are all indexes that we look at, or news releases that we look at throughout the week that could have a pretty big impact on the interest rates and how they trade. So Tuesday we have the U.S. trade balance. While we reset the screen there. The U.S. trade balance right there, and that came in. Moderate impact, kind of came in where we thought. Later, the government will issue their 3-year notes. Again, that could have a high impact if it's not met with good demand. The bigger one is the one that I want to highlight right down here, Thursday, September 13th. This is the Federal Open Market Committee. These are the guys that set the policy for the rest of the United States, including us here in California, and it has a high impact. This is where Bernanke is going to come out, and the market is expecting the federal government to probably introduce some additional easing into the economy to help continue to get us through this recovery. So there are still people that say the government won't. This could be a volatile point. So if they come out on Thursday and talk about things and they don't introduce any new easing, we could see some volatility in the stock markets, and that could have an impact on the interest rates. So you pull it up. Really, this is just where they release their statement on the monetary policy at the conclusion of their meeting with their Federal Open Market Committee. So again, could have some pretty high impact. What does that mean for you guys out there? Well, here's what we're suggesting. If you're closing in the next 7 days, you need to lock, take advantage of the market, and keep going. 7 to 15 days, I think it's a little tougher decision. There's some volatility out there, so if you're happy with the interest rate and you're liking what you're looking at, I'd go ahead and lock. There is some risk in floating that the market could move the wrong way on you, but there is some risk that it could go in the right direction if you lock as well. 15 to 30 and 30 plus, we're remaining a little bit more optimistic, and we're cautiously floating, which means that if you think there's a chance that the market's going to get better, we're going to float, but we're going to lock pretty quickly if we see any change of the signs there. So hope this gives you a great idea of what's coming up, and if there's anything we can do to help, we look forward to hearing from you. Talk to you soon.